Hello, everyone. Welcome to the webinar. We will be beginning in just a couple minutes. We have about 3 minutes to go, so welcome to the webinar, and we'll talk to you soon. Hello, everyone. My name is Lorraine LaChapelle. It's 12 o'clock. We are going to get started here in about 1 minute. I just wanted to welcome everybody to the webinar, and hold on, and we will get started shortly. Thank you. All right, everybody, we're going to get started today. Thanks for joining us in our down payment assistance webinar. Again, my name is Lorraine LaChapelle. I'm the Senior Vice President for Navigator Lending Solutions. We are a division of Land Home Financial Services. We are a nationwide company established in 1988 and are licensed in all 50 states with over 600 employees across the country. We partner with lenders and offer a broad product line of mortgage products with technology options and a portfolio fulfillment services. So we do a lot of different things for our partners, and we welcome you to the webinar. I am going to introduce Tom Morelli. Tom Morelli has been in the business for 40 years. He has been with some of the big mortgage banking companies, Lehman, Bear Stearns, AIG, but he's been with us for over 10 years, and Tom brings a lot of experience with retail, wholesale and correspondent channels, and deals with us on the fulfillment side as well. So Tom brings a wealth of knowledge, and he's going to be hosting our webinar today. I do want to go over the agenda with you. We did plan to talk about the features and benefits of the program. We definitely want to talk about options and what the eligibility is to get part of this down payment assistance for your customers and your members. We want to show you a little bit about originating options and how to submit loans. And then we will talk about how to sign up for the program. And then we will do some questions and answers at the end. What I'd like to do is just let you know that we have a question pane in the control panel. If you wouldn't mind clicking on that to go through that section, what I'll do is I'll read the questions to Tom at the end, and he will answer them because he has all the answers to those questions. So, and then we'll get started. So we all know down payment assistance is widely available. There's a lot of options out there. We tend to feel like we have one of the best programs out there, and you'll discover those reasons why in our slides. But there is some, understanding that down payment assistance isn't widely available, but there are so many options. One of the things that we have recognized there's some myths and some facts about down payment that are really misleading, and I think that's just the public not understanding. And so our job is to educate all of you, our partners, especially loan officers and management, of the benefits of some of these programs. We know that there's some misleading that down payment assistance is not for just low-cost homes. We did some ranges, and you could get down payment from $200,000 to $700,000. It's also a belief that first-time homebuyers are only allowed to do this program, and that's not accurate as well. So we're going to show you some of those today. And there's different kinds of programs out there. We're going to talk about the ones that we have specifically and why they work well for our clients, and we'll share those ideas with you. Down payment assistance also, I think there is some, again, some people that believe it's not available widely. I think you'll find today that you'll learn more about our program, and Tom will go over that and why we're targeting certain group of members or a certain customer list, and I think you'll see some benefits. So Tom, I'm going to turn it over to you.
Well, thank you, Lorraine, and thank you everybody for joining the call. This is probably one of the fun parts that I get to do, and that's talk about our programs and talk about our products and why they meet your clients' needs. When we're talking about members and clients, really, how do you pick them, right? Because this loan isn't for just everybody, and this loan isn't for just the common person walking down the street. We really need to help that member be identified. And some of those things that we want to look at is you want to look at the members that are financially stable. And what I mean by that is they have the ability to save, right? They can show the ability to make their rent payment. They can make their car payment. They can make their house payment. They can make their loan payment to the credit union. You guys can already kind of identify that member that you want to look at. Who else is that target member? We all are in markets today where the equity is screaming, values are screaming, and there may be limited seller credits out there, but this program works really, really well with seller credits. And we'll talk about how maybe you can help negotiate seller credits, or how you can help your real estate agent referral partners negotiate seller credits. We have a slide coming up that will show you, and I'll kind of give that hint because I live in Colorado and Lorraine is in California. As much as all of us across the country, I haven't had the ability to offer seller credits in a long time on a purchase. So this is something that'll give you a tool to add to that. One of the clients and that we see a lot of is the person that has been saving and saving and saving. And we all know how fun that is, right? But they've been saving and they qualify for a $450,000 home. But they've only saved up enough for maybe a $380,000 home. There's the ideal client for this product. And here's why. You then can take their money that they've already saved, right? combination of their money and combination of the DPA funds, you can get them into that $450,000 home, right? You can get them into that loan, and you now are the heroes of that member, right? We're all of a sudden giving them a set of keys to the home they really want, and they're not going to have to settle for that $380,000 program, right? Just muted myself, wanting to do my screen here. So we're going to talk about 3 programs today. We're going to talk about within reach, and we have a conventional and an FHA program. And then we're going to talk about our power purchase. And as these goes, the FHA one's a little bit longer, the conventional is a little bit shorter, and the power purchase is, whoop, it's done. So real simple, and we'll be going over that. But the first one we're going to talk about is FHA. All right. Now, this is a great loan for your members. There's a lot of things that make this loan ideal for you. One of them is that you have the access, and we'll talk about the qualifications here, but you have the access to offer a member a 3 to 6% DPA assistance program, right? Do they qualify for 3%? Well, FICO does that, and we'll talk about that. But really what it comes down to is what your borrower needs, right? What your member really needs to talk about, I've got this extra funds, right? We think about what that borrower is. And the money that they need to borrow to buy that home. So your members are out there and you're talking to them. Remember that you have an option to give them, right? Maybe they are that person that has the little bit of cash. You don't need 6%. Maybe they have a lot of cash, so they're just short just a little, right? They don't have the closing cost, or they just need a little bit more. Well, then you got the 4% program in there. And that's the idea of this program. It gives you options to work with your member to sell it. Now, this money can cover the down payment. It can help cover the closing costs. Your member is going to bring some money to the table, I promise that, unless there's a seller credit or a gift that they're working with as well. Now, obviously, prepaid items is part of closing cost. And then, of course, we have earnest money down there. How can a DPA cover earnest money? Well, if you have seller credits or a gift or something like that, if there's too much money at the end of the day, the member can get up to their earnest money back. And we have an example of that actually happening here in a couple of slides. So what is this program all about? First of all, you don't have to be a first-time home buyer, right? That's the first thing you need to realize. You could be a third-time home buyer. You could be buying the 60th home. The only thing is you can only own this home, the subject property, at the time of closing. So you can't have a portfolio of investment properties. Now, the member does not need to have the 3.5% invested into this deal, right? Because the down payment program covers that 3.5. You don't have to document that they have 3.5% already in the bank. You don't, all right? You have to document the cash to close. That's required. That's what you're gonna do. And we'll talk about a little bit more of that as we go. Now, one of the things here with our partners at NavPro, it's fun having them part of our team, is that you guys will be working fresh with them. So hopefully you're not going to have transferred case numbers or transferred appraisals. That's just something we cannot accept here on this program. Now, this program is a 30-year loan. That's all it is. No 10s, no 25s, no 15s, nothing like that. And you can work with the loan limits based on FHA. You can't exceed the conforming loan limit. So that helps a lot. And by the way, manufactured is allowed with no restrictions on the LTV. You just have the different appraisal and an engineer's report, but that's simple. Navigators, NavPros, and Lantone, we're all experts. So that's actually how this company got started. So we're experts all about manufactured. So we can guide you through that all the way through it. Now, how much is that DPA? When you're out there calculating that down payment, you don't calculate it off the purchase price. All right, so that's good, but you do calculate it off the upfront MIP total loan amount, right? So you've got your base loan amount of $400,000, you got your MIP making up a number of $4,260. That's what the number is based on, and we got a graphic that will show you that as well. So you do get a lift. You don't get it right off the purchase price, but you do get a lift by calculating it off that MIP. Now, how does your member qualify? That's really simple. It's FICO driven, like every mortgage loan is, right? And we have 2 tiers. We have the first tier, which is level tier 2, actually, when we're looking at it. That's the 640 to 659 borrower. And in that situation, you can offer them a 3, 4, 5% DPA. Now, here's the deal. The maximum DTI on that is 45%. We all seen those AUSs coming in at 54.99, 52.6. Yeah, if it's over 45, it's not going to fly if their credit score is below 659. Now, you're going to find out that you're going to be using the member for your members, the 4% most commonly in this bucket. And I'll show you why here in a few. But that's why, okay? That's that bucket. Now, when you get to the 660 and above credit score, things open up a little bit, okay? You can offer the 3 all the way to the 6, all right? The AUS determines the DTI in that situation. And if the DTI is over 50, there is a 1 compensating factor in there. That's okay. The FHA offers 3 options, and we'll take either one of those. So it's good on that. You know, every DPA program out there has some kind of limitation, right? Well, this one here has an income limit, and wait till you see the income limit. All right. But the cool part about this income limit, all right, is it's based on what you document on the 1003, right? It's not household income, right? So the AMI for this is 160%. Okay, so 160% of the area median income opens the door to a lot of members that can buy a home utilizing this product. So that's important. When I say documentation on the 1003 or the IRLA, the mortgage application, what's really, really important about that is if you have 2 borrowers that exceed that income limit, you can take one of those borrowers off and make it work. So that's what's really important about this product. We give you a way to get more members qualified for that. And one reason is that AMI. Okay. Only people who live are on the mortgage note can live in the home. So no cosigners, no co-occupants. And here's one, okay? Every loan, one of the members have to complete a home buying course. All right. Now, please don't go spend money on that HUD one. All right. I think they're up to 175 now. I haven't heard lately, but they're expensive. All right. You don't need to do that. You can use any mortgage insurance company. I recommend Magic because I've done it about 12 times just to make sure that it's still out there and it's working and easy. And it's online. You can do it in about 35, 40 minutes if you pay attention. An hour if you're multitasking, you know, and you get the certificate. And you just need to have that certificate before the clear to close is offered. And it doesn't matter if they're a first-time home buyer or buying their 97th home. One borrower, one member has to complete that. So you can have that member complete the Fannie Mae course, you can have them complete the Freddie Mac course, the Magic course, the Arch MI course. Of course, your team at NavPros can assist you in guiding you that way and provide you with links to whatever source of education that you would like to get to. All right, so one of the things about this program, remember we wanted to make sure that we had a customer that was stable, right? One of that is if they are a first-time home buyer or if they're renting today, we really, really have to document that they pay their rent, okay? That's the number one thing that will end up killing your loan is if you can't do that. But the cool part about you guys, you have your members, right? You already know how their cycle of cash works, right? So you know that they pay their rent and you know how to document it. So here's our rule for the VOR. If they're renting and they're paying rent, you have to document it, okay? So we need a written VOR. That can be a management company and or a private VOR, whoever they're renting for. And we need 12 months cancel checks or 12 months bank statements. We have to prove that the money that goes to the rent is actually coming from your member's account, right? Helps that you guys can have access to that with your client right there. So that makes it a lot easier to solve this problem. Now, what if they don't pay rent? Not a big deal. What if they live with mom and dad still? Or how about this? They were paying rent January through June. They moved back with aunt, uncle, mom, dad, grandma, whoever, right? To save up some money, maybe pay off debt, rent free. Well, then you got to kind of provide both of these items. But if they're living rent free, your member has to document that they can save money. And we need 3 months PITI in that. Gift funds cannot be utilized for this. So again, you guys are ahead of the game because you were already talking to that member. You already know how their cycle of cash is in their accounts. So it works, right? You're already looking at this, so you know how to do that. So this is really important. This is the number one reason that the loan doesn't go through. And these are required at submission. And we'll go through that later. But really, what does this loan do? How does it really work for your members, your clients, and how does it help the real estate agents, your referral partners, drive the business to your guys' door? Well, let's look at that. And this is an example, just basic example, right? But if you look at the purchase price, it's the same for whatever amount you are. But what's really different is that bottom line, right? How much cash does the member actually get? You can get, in this example, they're getting from $13,000 to $26,000, right? So, hey, that's a pretty good deal. And you kind of look at it, everything's down to the same. There's nothing really different. Obviously, the payments will be a little bit different based on the interest rate, but really the loan itself is the same. It's just really how much of the DPA your client is utilizing. Now, I told you we were going to look at a real life scenario earlier. Well, this is one that actually closed, and we literally just grabbed these numbers off the final CD. We added a couple of columns so it made sense, right? And things like that. But you can see across the board here how it worked. Now, this is one of those examples that the member actually got money back at the table. As a loan officer, that's the greatest phone call in the world, right? You're not calling them and saying, hey, you're going to bring $29,000 to the table. We'll have a cashier's check ready for you, right? You're calling them saying, hey, don't worry about anything. We're going to deliver you funds at the table. And that's exciting. That's a great phone call. But let's look at how this works. You know, they had a closing cost of $9,600, right? They had an appraisal fee of about $750. The compensation that comes to the loan originator in this instance was $10,000. They actually took the 2%. All right. The down payment was $18,000. So they already had 18 grand of their own money that required in that. They had earnest money of $5,000. So they had $5,000 of their own money. Seller credits, right? You can get up to 6% on this program because it's an FHA program, right? But we all know that markets are tightening, right? Colorado, California, Arizona, Nevada, none of those states really right now have a market where seller credits are available. But in this example, look at the power that you can have when you say, okay, the client's got $5,000 into it, actually 57, right? Because of the appraisal. And they're going to get $30,000 from this down payment program. We're short, Mr. and Mrs. Realtor, Mr. and Mrs. Seller, whoever it is, right? We're short about $2,500. Oh, hey, we could throw that in, right? That's not even 1%, right? So this is the power of how you can use the DPA program to help sell, getting the seller to throw in a little bit. You know, no one wants to throw in, 30 grand, right? As a seller, why would I want to do that, right? Unless it's that kind of market. So in this situation, you're just asking them to throw a little bit in, and it got the deal done. They didn't have to worry about it, and everybody went. But look at the bottom line. If they didn't have the DPA program, your client's bringing in $30,000. What a program this is, right? And combine it with that little bit of help from the seller, it works. Now, you can combine this DPA program with seller credits like we talked about it. And we talked about that you can combine it with a gift. As long as that gift meets FHA requirements, you can use the borrower's own funds like we used in that example at the very beginning where they saved, but they didn't have enough, right? So you can combining it that way. So that's the power. So we're talking about how this works. We looked at the real life scenario, but what really happens when you give them a DPA? Well, it's a second mortgage, right? No shock there. Most of them are, okay? This is a 5-year mortgage, okay? Has a 0 interest rate, all right? It's forgiven at the end of a 5-year term. So in the 61st month, it's 100% completely forgiven. They do not have to pay a dime back, all right? Now, they do have to stay current on the mortgage for us to forgive it, right? Their first mortgage. That's You guys got good members, right? So that's not a problem. So you're going to work at that. Now, if they sell the home in that first 5 years, they got to pay back all that $29,000. If we think about that example in the prior screen, right? If they refinance that home in the first 5 years, you know what? They got to pay back that entire 29,000. Now, when you're talking to your member and they come in and they say, "Hey, I want to refinance," you look at the date and you go, "Well, you tell you what, let's wait 3 months, and then we don't have to worry about paying back that 29,000." They're gonna love you, right? That's what it's all about. But this is a second mortgage. Oh, right, the headaches. No headaches here because there's no payments on the mortgage application. There's some detail that you have to make on it, and we'll show you that later in the presentation, but there's no payments detailed on the IRLA here, all right? There's no second mortgage file, right? You just detail the first mortgage file. Your team members at NavPros can do that with you and for you. That's the key about partnering with this team, is you have all this assistance and help in that. So, but no mortgage application, no second mortgage file, no second mortgage approval. That's right. So if they're approved for the first mortgage, they're approved for the soft second DPA program. Really simple. They don't have to lock. You guys don't have to worry about, oh, we got the first locked. Oh my gosh, let's go lock the second. You don't have to do that either, right? Because once the first mortgage is locked, don't worry about it. The second is taken care of. That's the power of Land Home and NavPros. It's all done for you, right? Simple. We're trying to make it as easy as possible. And then we've all used DPA before, you know, and you're like getting going, you're excited, you got to clear to close, you're getting your client all happy, and then you know, oh, I got to get the funds, right? You don't have to worry about that either. Funds will be there, guaranteed at the table. It all comes through the Land Home. So that's the power of the team that you have and this program. Now let's talk about how these loans get submitted and what's required. So when you're talking to your member, you're saying, well, this is what we're going to need to see if you qualify and things like that. So we're going to talk about that. Now, there's AUS, and again, you're working with your partners at Navigators. So it's all, they're going to guide you and they're going to help you and everything like that and assist you gathering things. But this is what you're going to have to talk to your client about, right? You're going to say, we're going to have an income documentation. That's not out of line. Now, in this situation, because it's a DPA program, you know, some AUSs out there go, oh, you don't need that. We're going to need this, okay? We have to have a written VOE that covers 2 years. That's actually FHA guidelines. So that's not out of line. 30 days of pay stub, right? 2 if they get paid monthly, 1 if they get paid every 30 days, things like that. And then, of course, 2 years W-2s. Only if they're self-employed, you know, Schedule C, subcorp, full corp, whatever. That's the only time you need tax returns. All right. If you have a W-2 borrower, don't grab their tax returns. If that's all their income, they don't have a side job, you know, where they're doing something Schedule C, something trying to get a business going, thing like that. You don't need, you know, just use the W-2s, right? Only if they're self-employed, only if they file Schedule C, 1120s, 1061s, or things like that. That's when you need tax returns. The simple reason is if you give us tax returns, we have to underwrite it, right? We don't really want to do that. So, right? All right, so that's part of the submission. You need that in there. Okay, we talked about the rent, right? Gang, that has to be given to the underwriters at the initial time. Here's why. This is, again, this is the number one reason loans are declined in this program, is that we don't have the stability of somebody paying rent or the ability to save. So think about, you're talking to a client, they're all nervous about buying the first home, right? They're renting right now. Oh, we got to get out. They got that home. They're all excited about it, but they're nervous getting a loan approval, right? And you say, don't worry about it. Not only that, we're going to use some DPA to get you that bigger home. So we're going to get a down payment second that helps you with the down payment of closing costs. Well, you just raised their excitement level, right? They were nervous about getting a loan. Now they got to qualify for a DPA. Well, this program takes care of it, right? You don't have to worry about that. But here's the other thing, right? You have 2 real estate professionals that just, oh my gosh, we're using a down payment program. Experience, you know, that however they have, this is something that there's like, they just don't want, right? We get all that documentation up front, including the VOR. When that approval comes to you, you're about 90% done, right? You're not going to have to worry about income. We looked at it. You're not going to have to worry about the rent and, oh God, right? It's done. It's already signed off, cleared. You're going to get the conditions of, oh, you need an appraisal. And of course, your partners at NavPros will help you and take care of that ordering for you and everything like that. You know, you're going to have to get a couple of letter of explanations and things like that. Basic stuff, right? So we get all this information up front. You don't have to worry about that, okay? One thing I want to remind you guys about there are student loans. We've all seen those, right? And we threw the slide in here as a ding-dong remembered thing, right? Because what I've yet to see a credit report give us the right payment if they give us a payment on a student loan, right? So this is really, really important because we do not want you guys to get a client or a member going and all of a sudden, oh, student loans ain't that. Now remember, your partners at NavPro will help you and guide you through this. So it's really important. But one thing is the rule on student loans has changed for FHA. It used to be you calculated 1% of the outstanding balance, even if it's deferred, towards the borrower's debt ratio. Ah, that, you know, you've seen $265,000 student loans out there, right? So that can hurt and it can jeopardize that process, right? So please note, one, that's changed as of August 1st, but Landhome and NavPros is making that change today on all loans, that it's actually 0.5% of the outstanding balance. So that helps a little bit in that situation. So don't forget about student loans. Make sure it's out there. Take a pen when you're working with the credit report and things like that, or get with the people at NavPros and they'll help you through this process. So we just threw that in there so that it was a reminder and to let you know that it's changed and we're taking that change today. That's exciting news. Asset documentation. Well, we got to make sure. And this is the cool part. You guys have access to it. No matter what the AUS says, you know, it's going to say you may have to document. You always have to document what cash they're bringing to the table. But this program requires 2-month asset statements. Okay, on all of them, again, at the time of submission. Here's the thing, you guys you can kind of pre-screen your members there. If they have overdraws or their account balance ever goes negative or zero, that's not a stable borrower for this program, so kind of move on, right? There's other programs that you can bring them into. And again, your partners at NavPros, they can navigate that with you and show you maybe a different product that they can assist you with in that situation. NSFs and overdrafts are considered the same. If they have overdraft protection, it's still a NSF in our underwriting world, so that's a negative effect. We'll allow one NSF as you know, and let's say there's 3. There's errors sometimes, or if it was, you know, whatever, something in COVID happened and things, we'll look at that as if it's only happened at a one time, it's isolated, things like that. But if you're looking at an everyday member and things like that, if they have an over abuse of more than one NSF, it's really not a program for them. Okay, that really covers the whole FHA program, right? It's a great program. We'll cover some really quick things about it. It's not required to be a first-time home buyer. You can be. That's cool. All right, that's a great assist out there. I can do that. Your income is 160% of the area median income, and it's only based off of what is detailed on the 1003 or on the what's detailed in the loan file. So that's really, really important to make sure that's there. That really helps a lot. Also at 160%, you can actually get your borrower member to maybe look at a 1 to 2 unit, maybe even a 3 unit. They can live in 1 and rent out 2. That those potential rents go against that area median income, but 160%, it might have the room to qualify in that situation. So a lot of positive in that FHA program. Plus, you have your credit scores down to 640, and you can go up to a higher debt ratio of 50 plus if you have a 660 and above credit score. So a lot of advantages there, plus the dollar amount that you can get for your client, 3 to 6%, depending on their credit score. So what about the conventional product? Well, this is a really simple product as well, and it's a great product, all right? And in this situation, it's a 30-year term. It still has the 5-year second soft mortgage, all right? We'll talk about that, it's really different. So that's great. Income limits are a little bit different on this program, okay? They're 80% of the area median income. Okay, it's still based off on what's documented on the mortgage application. our wonderful Erla. So it's based off on what's that and what's documented in the file. Again, your partners at NavPros will help you out in that situation on that documentation and how to structure the loan. So it is like that. Remember that the AMI in this program is 80%. We actually use the AUS is LPA, which is a Freddie AUS, and you have to use the home possible identifier, and we'll talk about that a little bit later. It's not, I have to do the small print now, this is not a Freddie Mac loan. We just simply use the home possible guidelines and AUS for that. So again, this is a 5% product. No minimum member cash needs to go into it. So their down payment is 3%. So you get 2% for whatever closing costs they need to use. It can do that. Again, they don't have to be a home buyer. And one of them has to go to school, right? So they got to get that taken care of. Again, in this situation, do the Freddie Mac course. It's free, it's online, and we just need it before the clear to close. So I did state that it's a 5% program, not a problem there. 620 minimum credit score. Yeah, that's what the program allows. You're not going to see an approval at 620. You're typically going to start seeing approvals around a 680 credit score. Most of the programs that Land Home sees or borrowers that we see that utilize this program, their credit scores are actually above 700. All right, so that kind of gives you an idea. Just the conforming loan amounts, no high balance, no super conforming loans, 97% maximum LTV. Now here's something. Sometimes you don't get an AOS approval at 97, but you get one at 95. Well, there you go. You can take the whole 5% and throw it towards the down payment. Your member is still going to have to come up with some closing costs. They can use a gift. In this situation, it's up to 3%, as long as it meets the guidelines to the program. That's good to do. Or they can use their own funds, right? Think about that borrower, that member that has, oh, I need to borrow 420 grand, but I only have enough to borrow 380 grand. So your member, they have their own cash. They haven't saved it up enough. And we all know how fun that is, right? There is outside MI like this. It's 25% coverage, no matter what the AUS says. And again, only people that are on the note live in the home, so no co-signers or no non-occupant co-borrowers. That's always the hardest thing in the world to say. All right, let's talk about the soft second. It's really the same thing, right? The thought process of the loan is the same as we saw in the FHA. Loan amount, blah, blah, blah. It's all based off the loan amount, so it's real simple. Now, again, this soft second is a 5-year mortgage with no interest rate, no payments that you need to worry about. It's forgiven in the 61st month, so it's all the same in that situation. They do need to stay current, and those rules apply. No selling, no refining, or you got to pay it all back. So it's really, the program follows the FHA thing. What it does, though, is it offers DPA to the higher quality credit score borrower, right? All right. So what happens if you have a credit score of 805? Perfect one. I start thinking about the conventional program right off the bat, right? Okay. Then all of a sudden you realize the debt ratio is 48.7. Oh, doesn't qualify for this loan. But you still can get them a DPA, right? Because you can just work it backwards to that FHA program, because you can have that great credit score 805. You can go 48% or higher, right? As long as you get the AUS approval. So there's options that you can give to your member in that situation. That's the power of the within reach down payment programs, is that you have lots and lots of options. Now in this situation, the soft second's the same. Great. It's easy, simple. No payments, no documentation, no file. You don't have to worry about locking the second mortgage. You don't have to worry about requesting funds. You just worry about that first package, that first mortgage, keeping your member happy, answering their questions, making sure that you're relating to the real estate agents and your referral partners, that everything's going well. This is what we're doing. You ordered the appraisal, all that. Your partners at NavPros will guide you and walk you through that all the way across. So everything there is the same. So this is the great program of the within reach conventional. I told you to get shorter, right? So now let's talk about that. It's a 5% program. You're talking of credit scores 680 and above. You're talking about a debt ratio of 45. That's the maximum. All right. However, the AUS is going to give you one higher than that anyway. Minimum down payment is 3%. It can come from this DPA program, as well as the loan origination cost in that situation. You can get up to a 3% seller credit or gift, right? As long as it meets the guidelines. So it's a strong product. Combined it with everything that you can think about it, but I got a backup if all else fails, right? A little high debt ratio, fine, I can do the FHA, right? So your rates are very comparable, and we'll talk about that here in a second. But let's go on and finish the presentation. Our last down payment program is Power Purchase. Now, this is actually a 1% down payment program. All right, that's right. Your client only has to come up with 1% down payment. And you know what's cool? It can be a gift, right? You do not have to document that the client's got the 3% down payment. No, you got to document cash to close, all right? And what's really fun about the within reach conventional and the Power Purchase, you don't have to worry about the VOR. You don't have to worry about that NSF. So these are really good products in that situation. So, you know, you got that 805 client, this is where you want to start. If you need that FHA, it's right there back there. If you're below that 700, it's automatically FHA. That's where you're going. So again, those options that you can drive that. Now the Power Purchase with the 1% member down payment, that means they'd have to come up with 2% from somewhere, right? To make that 3%, that's the DPA. What's cool about this is it's a grant. It's not a loan. So it's immediately forgiven at the time of funding. So when you hand those keys over to your member and you go, enjoy, forgiven. They don't have to worry about it at all. And that's what it's really cool. So this one has a little bit of different guidelines. 620 minimum credit score, yeah, more like 680 or 700 and above, right? Income limits is still 80% AMI. We use the Home Possible underwriting engine through LPA. Again, it's not a Freddie Mac loan program. We just utilize their guidelines in AUS for underwriting. Conforming loan limits. Now here's a big one that's different. It's 2%, right? That's the Power Purchase. It's based off the purchase price, not the loan amount, right? So that's what you got to worry about there. Again, grant, no repayment. Don't even think about it. It's gone, forgiven. That's really good in there. Simple stuff across the board in the realm of everything. Everything is pretty much normal in a conventional loan situation. All right, so we're getting through this conventional grant program. This can be, the rates in this one aren't par like they are in the within reach. There is a little bit of room of seller credit, not much. I'm talking about an eighth or a little more than an eighth that you can assist the client with closing costs and situation. Our standard fee is $9.95 here at Land Home. On within reach, it's $14.95. And in this situation, it's $9.95. Not a problem there. All our down payment programs, the Within Reach FHA, Within Reach Conventional, and the Power Purchase is allowed in 49 states and the District of Columbia. This product is not eligible in the state of Washington. You know what? That's okay. There's lots of people in other states. So just to let you know, that's across the board. Now, mortgage insurance for the Power Purchase, there is mortgage insurance across the board. Manufactured home is allowed on all products. On the conventional within reach, it's a grant, all right? It's not a soft second. So that's powerful in that situation there. So you do have this manufactured home ability. You have MI on that as well as the stick built standard stuff that you would see on the AUS. Again, your partners at NavPros will walk you through and guide you and assist you in that situation. So at this point, I'm really going to kind of turn this over. I'll come back in a little bit, but I'm going to let Lorraine take over a little bit, give my voice a little break. And so Lorraine, I'm turning it back over to you. Lorraine, you're muted. Did I lose Lorraine? I guess I could fudge.
You didn't lose me. I'm
Okay,
muted.
good. Well,
I'm
I was
here.
getting ready. I was getting ready to do something there. But thanks, Lorraine.
No problem. Thank you. So with our partnership programs with our clients, we have options available for assistance with processing, obviously, especially when it comes to complicated programs like down payment assistance. And we do have some of our clients, just so you know, are fully able to process these loans, feel totally comfortable, have capacity in their There are shops, it's not very many on the credit union side or the banking side, but there are some that can do it. If they do want to export a full file into our system, they can export out of their loan origination system, and they can, again, just go right into the Express site, deliver the file right into underwriting. They can do that. They also have options with us in order to go into our site. They can export a file into our site, or we could help them with the loan origination system or a application. So there are options around our partnership levels. Some clients want us to have the loan application linked on their site. So we'll put the bullet points about down payment assistance. If you want to apply for that, click here. We can create a loan application in the credit union's name, the bank's name, or and that with that loan officer's information at the institution, but that file will come automatically into setup, processing, underwriting, and closing, and we will be moving that file along. And then one of the creative things that we did, I think, is our lender advocate program. We developed that about 4 or 5 years ago. We found that a lot of institutions can focus on conventional lending, portfolio lending. They really are good at that. Their operation works well at that. But when it comes to outside of that, down payment assistance, FHA, VA, reverse mortgages, home renovation, when it comes to complicated products, they just don't want to burden their internal staff with those. So they can do the origination piece only. And through our lender advocate program, we will actually structure the loan, help them structure the loan, that loan officer at the credit union, tell them what that price is and what that loan amount's going to be, and that our lender advocate team will then give that back to the loan officer, let them give that quote to the member. And then once that's ready to move on and the member says yes, then that goes through our system, and then we will finish that all the way to closing. So there are a lot of options with our partnership, and I think that makes it really helpful to right size the credit union or the bank's staffing. And Tom, I'll turn that back over to you. I think you're going to talk about submissions.
I will, and I was able to get a drink of tea, so my voice is not going to crack when we get in here. So thank you, Lorraine. And gang, take advantage of the tools that are presented here with Land Home and NavPros. We're together, we're a family, we're all part of that, and we all have great teams, and that's the fun part. And we give you the options of how to build, right? We want to bring more loans to you guys. That brings more members, more clients, more referral partners. So that's what it is. So what we want to talk about is, how do these loans get into us? Well, first of all, we want good, clean, fully processed loans. So if you're doing the processing your loan on your own, great. We accept that all day long. We love it, right? We take it through our wholesale channel. And we could definitely show you how to do that But what we've done is we've provided on our website, lhfs.com, wholesale.com, excuse me, and there's a submission checklist. Follow that, you're good to go, right? I got this, I got that. Okay, I'm good to go. There's like 15 things on one and 7 on another. So you just get it all done. It's really simple. We do, like I said, we want those process files up front. Makes your life as a loan officer a lot easier when you're dealing with, because you're the ones getting the phone calls, right? We don't want you to I don't know. The last thing you want to do is stutter and go, I don't know. So we want to make sure that you got it all, and that's why we want these really clean files up front. So really simple stuff, as you can see on the screen. Now, NavPros, again, they can walk you through, they can assist you, they can do it, they can work with your member, they definitely can keep you in the loop so that you're, again, answering those phone calls. You can go, this is where we're at, this is what we're doing, or you can actually beat that phone call, right? Just wanted to update you, real estate agent, we got a clear close, or whatever it is, right? You can do that. And remember, that's the power about having a true quality fulfillment company behind you, and that's what NavPros brings. So again, look at all the things that they can do for you, all those things on the other screen, but they're getting it done, right? So that's what we can think about in that situation. Now, there's a little bit of things, if you're doing your own, and when you're talking about your client, you're doing those applications, if you're not utilizing the NavPros team, There are stuff on this wonderful new ERLA that has come out that we really need to make note that you got to get it done. And one of them is if you're doing one of the within reaches, the conventional or the FHA, you got to show that second mortgage, even though it's a soft second mortgage. You got to, I said no file, but I didn't say, you don't have to do this. You got to show it as a subordinate lien and the actual dollar amount, right? So our example, we made it simple, 5,000. But if I use the example from the slide, it's at 29,185, right? So that's what would be going in there. The other boxes are blank. One of the other sections that our new ERLA has come up with is the declaration. Remember, there's two declaration pages in the wonderful ERLA. But 5C, you got to do it again. This is where you say, do any of the down payment borrowed? Yeah. Closing it, borrowed. Yeah. And then you say yes, and you got to mark the 5,000. Now, if you're doing your own files, this is where this is really tricky, because as a loan originator, we default our system to all go no, 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 no. And we forget about it. I got to change 5C to yes. So remember that. Again, your partners at NavPros will definitely work that out and assist you in that situation. All right. What if it's the power of purchase? Oh, it's a grant. There's no subordinate, right? Or if it's a within reach manufacturer, it's a grant, all right? This is all you said. It's actually in 4D. It's a gift or grant. Pretty simple, right? So you put the word grant in there, you put a federal agency in there, and you put the total dollar amount. Really simple there, and that's the basis, okay? Now, we talked about locking, right? When you're locking a loan, the first mortgage has to be locked. That loan has to be locked by you guys through the express system here at Land Home. Very simple to do. You cannot lock any of these loans until they're conditionally approved and we've reviewed the appraisal. Remember what we said? I said earlier, I really want you guys to feel confident that when you're telling your people you got this done, you do. And this is what we want, because in the end, if a locked loan is declined, we're charging you $400, okay? And that cannot be passed on to the client or your member. So only lock these things in real. We've had clients say we don't lock them until we get a clear to close. We've had clients that don't lock it until they send it to, they know that they're going in for a final approval and they know it's real, nothing really hanging up. Again, think about that. Your income's already signed off, your VOR is already signed off, your assets are already signed off, because that's all part of the submission. You're really down to where that heart throb down for that clear to close is gone, so you don't have to worry about that. Again, whoever you're working with at Land Home can assist you in that situation. And of course, the NavPro people will assist you and guide you as well. So that'll work. Well, we're going to go ahead and open it up for questions, and we'll answer questions across the board. Okay. For within reach FHA, within reach conventional, or the power of purchase. So be willing, if you haven't already asked, ask away. We have answers for everything, even if it's no. Ask whatever you need required for these FHA loans or conventional loans or the power of purchase product. And while I do that, I am going to put up another screen here with all your contact people at Navigator Lending Solutions, and that's the greatest part here. You have a great team of people to contact and keep you in. So let's go ahead and start answering questions if there are, and there's one more slide here. I'll change in the middle after a couple questions, but I just want to make sure everybody has a chance to grab that. We are recording this, so I'm sure that if you want a copy of the recording, just get with one of these people and they will be able to provide you a link for the recording. So Lorraine, do we have any questions?
We do. We have a couple of questions. The first one is a soft second forgiveness. Is one delinquency all that's allowed? So is it 1 day? Is it 30 days? What happens?
Well, that's a great question. Delinquency, not late, right? That's how I kind of want to put it, right? When we look at a credit report, we say, oh, they're delinquent. That's their 30 days past due, right? They're late. Well, you don't get a late charge until the 15th, right? Just delinquent. So anything over 30 days past due. Late is okay. Delinquent is 30 days plus.
Okay. The next question is, are there any exceptions to credit score on the Within Reach program?
No, there's not, unfortunately.
Okay. And that is it for questions. I don't think we
Okay.
have any others.
Well, I can help you guys out there. I know that some of the question, well, what are the rates? Well, one of the rates for the, we'll start with conventional loan because there's only one, right? There's only the 5% option. That today is at 4 and, is that 3, 4 and 3, 4.325. I'm trying to do this in my glasses and it's not up close enough. So 4 and 3 and 3, whatever. So FHA, 640 score, we got 3.5 for the 3% program. Not very used a lot. Here, remember I said you guys would use that 4% a lot. And I am going to bring another screen up for you guys. Now, I'm pretty sure you've got that down. We do check with your partners. They can provide marketing for you to where it's, you know, white branded for yourself in that. Back to the rate, 640 at 4% DPA program. That interest rate is 3.75 today. The 5% at a credit score of 640 is 5%. Remember when I said you're going to be using the 4? That's why. Okay. Now we do a lot of those 5%. I do need to make sure you guys aware that rate is a little bit higher than the 4% DPA program. It may fail HPML, which we cannot grant. So if you're looking at that, let's make sure that we test that HPML high cost high price mortgage loan test up front so that we can make sure that it'll qualify. Now, if we're looking at that FHA 660 and above credit score, that 3% DPA is at 3.25. All right, that 4% DPA program is 3.5. Now, when you're looking at the 660 bucket, which is by far the best bucket that you're looking at for your clientele, your members, this is why, because you got more flexibility, right? 3, 4, 5, and 6. You're going to do a lot of 4 and 5%. Favorite one by far is 5 because that interest rate is 3.75 today. Now, these rates have not changed since March of 2020. All right, so think about that. That's why locking isn't, you don't have to have that heart attack. All right, you don't have to have that, oh, I've been locking. It's okay. Rates don't really change, and we'll let you know if they are. All right, so that if you need to get them locked, we'll give you that chance. Now, the 6% program, the 6% DPA is only offered on the 660 and above credit score. That interest rate is 5% today. All right, so, and the power of purchase is based on market rate. So I think that helped. I want to thank everybody for joining our call today. I noticed that we had quite a few people out there. You know, these programs are there. NavPros has a lot of things that they can offer for you. Of course, Land Home has a lot of products out there that we can offer as well through the wholesale channel and correspondent channel, all teamed up with NavPros. They assist with both of those divisions. So it's a great family here. If there's no other questions, I would like to thank you. Lorraine, thank you for being my partner on the call. We appreciate that.
Thank you, Tom. I appreciate everybody coming today. We plan on having these webinars throughout the year. So be looking for our next invitation. We plan to educate you on every product we have, and we'll be coming up with FHA, VA, reverse mortgages. Anyway, we'll have a variety of products out there so that you can learn more on a regular basis. And these flyers are available for our partners. We're happy to share those with you, and your marketing department can beautify them on their own if they would like. So anyway, thank you all for coming. Have a great day, and we'll see you next time.
Thanks, everybody. Bye-bye.
Bye-bye.